Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about dividend growth investing. But before we get started, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at OTOTnow.com. Now, let's get started. Okay, in the last episode before the Financial Thought Leadership Series, we talked about the different types of investing. And whether you're new to investing or you have been doing it for years, different times in life call on different strategies, and maybe you don't have a strategy and you're thinking of a strategy. So sometimes investments can be, they just collect like stuff in a garage sometimes. Generally up to the age of 40, you could have a bunch of good ideas. It all goes into the garage, and really you need to go through it every now and then and figure out what needs to stay, what needs to go. Very similar to cleaning out your garage is cleaning out your portfolio, but it does start with the strategy. So we talked about a couple of different types of strategy, but the specific to this one is the dividend growth investing strategy, which I will tell you about now. So the strategy takes a pass on home runs. If you use a baseball analogy, you're not trying to get home runs. You're not trying to buy things that are going to double, triple, and quadruple. You're trying to get singles. So every position is out there, just like every batting in a baseball lineup is out there to get a single. And you know, in baseball, if everybody gets singles, you'll score all kinds of runs and you will generally win the game. You don't really need the home run to win. Very different from total return strategy is you have very few names, not necessarily very few, but you certainly don't have 500. You probably don't have 50. You might have only 20, and you are looking for your home runs, things that can go up several hundred, if not 1,000% over a course of a decade or two. So that's not the dividend growth investing strategy. Again, you're looking for singles and not home runs. Think of it as a grind. This is very much a get rich slowly sort of thing. You are trying to preserve your capital. So the positions that you buy, you don't want them to go down in price. That's preserving the capital. But you also want them to generate income along the way. So it perfectly kind of supplements, if you're a buy and hold by nature, which is that gatherer type of mentality of once it goes in the portfolio, I kind of want it to stay there because I really don't like selling, and because every time I sell, something goes up and I get mad. So if you're a buy and hold strategy person, then the dividend growth investing is really kind of perfect for you, because something once it goes into the system, it generally stays there unless something significant challenges the company, like a COVID-19 has challenged some of these names. But we can get to that. If you are enjoying investing, i.e. you're doing it for the adrenaline hit, you're not going to get it with this. This is a very boring strategy, and much like flying, when I like flying analogies, boring sortie is perfect, right? I don't want to have excitement. I want to go from take off from A, execute the mission, and land at B, really with nothing notable at all that I hadn't already planned for. That's my job as a pilot and a planner. So you don't have to go all in on the dividend growth strategy, because that would keep you out of a name like Amazon, because Amazon doesn't pay dividends. Just went over the 3,000 mark today, and of course still has more room to run because it's kind of taken over in this work from home environment. So when you think about a DGI strategy, you want to think about most of your portfolio. So maybe you're in retirement and you're living off your portfolio, and this is the perfect strategy to kick off 4.5% to 5% per holding. So the whole $1 million portfolio kicks off $45,000 to $50,000 in dividends, but you can still have 10 shares of Amazon off to the side. It's not really part of your DGI strategy, but you can supplement it with what things that keep you interesting, plus names you want to be in that don't pay dividends or don't pay dividends yet, right? So it's not that easy to execute this strategy. So that's why, if you want somebody to help you with it, there are mutual funds out there that will do it. I think those are too expensive. There are index funds, NOBL, which is a 25 holding dividend aristocrat group. I still think it's better to build it on your own, but it's really up to you, or have somebody help you with it. Okay, so the core of the strategy is the dividend growth company. So dividend, let's break that term down. It has to pay a dividend, first of all. So like we talked, Amazon does not pay a dividend. So there it goes out of your out of your portfolio because you're focusing on not only companies that have dividends, but that have grown them over time, showing you a series of dividend increases. There are aristocrats out there that have increased their dividend every year for 25 years. So those are the names that you're kind of looking for. As far as the dividend itself, you want 4% or more to make it worthwhile, and you want a track record of dividend increases. There's a little bit of judgment here because going through 2007, 2009, you would understand if the company didn't raise its dividend, and also in the first half of 2020, you would not really expect the company to raise its dividend right now because we don't know where we are in the big game yet. So, but you can look back and what I would call maybe the easy years from 2009 to 2019. Yeah, you should see almost an annual dividend increase. Maybe only a penny or two, but what that shows is when you see those actions, what that tells you as a stockholder is that the leadership team of that company values their dividend. They value increasing that dividend, which means they in turn value you as a shareholder, and they want you to stick with them during the downturn instead of bailing out of their stock. So when you have that kind of underlying message from the leadership team and it attracts that sort of shareholders, those companies, when we do go through a market crash or correction or the COVID hit of 35%, in general, these companies do not decrease in value as much as the rest. So that's what you're looking for. As far as what makes up the company, that's what the portfolio, that's what you're looking for. Now, the output, whether you can be conservative, you can be in growth phase, you can be a 25-year-old and just like this strategy. Absolutely. Once you buy it, you hold it, it pays dividends. If something pays a 5% dividend, it is math that if you hold it for 20 years, the stock has paid for itself. And that everything you've gotten along the way is now free, right? That's a pretty good deal, right? So you can use this strategy. I prefer the total return, but hey, this is really suited for that moderately conservative to a moderate type investor. And again, you can supplement it on the side if you want a couple of high flyers like Amazon, but you don't have to. And let's talk about the math as far as income generation. We talked earlier in the podcast, several episodes on where you need to be at each age, and i.e. what multiple of income. Well, all of that is to get you on some sort of plan to whether you know you're on target or not. At the end of the day, though, when you are in retirement or you start taking income out of your portfolio, wherever you are on the still working, still not working, working part-time chain, you can think conceptually that for every $100,000 you have in your portfolio, if you average 5% dividends out of those holdings, which this strategy would be right around that 4.5 to 5%, then that's 5,000 years of dividend. $5,000 of dividend income per year for every $100,000. If you have $100,000, that would kick off $5,000 per year in dividends. So you don't have to sell any stock. You simply get to live off that. If you take it monthly, which I have many clients to just say, hey, whatever I figure out there in an Excel spreadsheet, it's like, hey, your portfolio is going to generate this per year. And they're like, all right, chop it by 12, send that to me monthly, like a paycheck or another Social Security check or a pension check. That's how you're creating your own pension. I'll do that math example completely in another podcast because some folks have asked for that. So if you think just you have $100,000 to your name, it kicks off $5,000 a year. That's $416.67 a month. Now, the money doesn't come into the portfolio that way because dividends pay out every quarter, and depending on your holdings, some of them might pay out at the same time. It doesn't matter. That amount is coming in, so therefore, when you set up your portfolio to send you that check or that electronic deposit in your bank account, that hits every month, and you don't have to worry about it because the money's going to be there. That's how you live off your portfolio. Obviously, if you put a zero behind that, if you have $1 million portfolio, then that would be $50,000 a year in dividend income, and now your monthly is $4,166.70. So you can see now that how that would make, and again, if you're a six-figure type of person, you should have over $1 million portfolio entering retirement, And you can still see that it doesn't generate a lot, but that's what it generates without you touching principal. And of course, that's like, you know, the milk from the cow analogy. You use the milk, don't touch the cow. And in this case, the cow is your portfolio. And that's what you're trying to do. Once you start cutting into the cow, then you get less milk, and eventually you kill the cow. So when you think about it, so that's how you have your portfolio set up, whether it's 100,000 or $1 million or 5 million or wherever you're at, doesn't matter. If you're using this strategy, just think about it though. Every time, let's see, ExxonMobil, you see you have your alert set because you still want to stay engaged, and you get a stock alert that says ExxonMobil is increasing its dividend by 4 cents this year. Well, that's a penny a quarter. So you can, most people who do this actually create a spreadsheet. If not, I do it for them. It takes me 5 seconds. It's that fast. But using Excel, you automatically download stock prices, put in the dividends, you do all the little math, and it tells you exactly what you're going to make. Now, that's not much of a raise, but when you think every year and you think pennies and you have hundreds, if not thousands of shares, it adds up. Okay. So no kidding, no joke. This is a dream. And you used to get these checks in the mail. You don't anymore. You actually still can, but your brokerage house will hate you. But you know, people used to love to go get the dividend checks in the mailbox, right? Well, now it's more of a direct deposit sort of thing into your brokerage, and you take whatever you want out monthly. But yeah, how cool is that? And every time any of your holdings, say you have 30, and you start getting one's raising the dividend, so will the others, and pretty soon the thing just keeps going up, 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 and up, and you go live your life in retirement, and life is good. So the share price will fluctuate. So disassociate that from the dividend. The dividend is a set amount. Say it's $2 a year, that's 50 cents a quarter. Stock price will go up and down with the craziness of the daily market, which if you're in this strategy, you probably don't particularly care for the craziness of the daily market. It's emotional. It's headline dependent. It can get tied up in politics. It can arguably get manipulated at the highest levels. I will not say that that doesn't happen. It doesn't matter. If you own the share of stock, you get the dividend. You also get the rights to go vote if that's your thing. I found most people don't, because you don't quite hold enough to really make a difference, but you certainly can go exercise your right. But that dividend stays the same. So if the stock price is 40 and you're getting $2 a year, that's a 5% dividend. If the stock price goes to 20 and you're getting $2 a year, well, that's a 10% dividend. You still get the $2 a year. You still get the 50 cents a quarter. So the amount coming in the door doesn't move, but some of the math does move as far as yield, percentage, all that stuff based off of the stock price. So you do not sweat the stock price. Now you need to watch to make sure that company's not going bankrupt. Okay. Ford cut its dividend this year. That's a big deal. A lot of people probably relied on that dividend to live off of. Well, they suspended it. So it's at zero now, and they're going to bring it back. Am I worried about Ford? So I have to ask myself, okay, if I hold Ford, which I don't, my first question is, ooh, they just cut their dividend. Are they going bankrupt? That's all I care about. Are they going bankrupt? Period. Period. Dot. That's the end of discussion. I look at all the information. I'm like, nope, I don't think Ford's going under. If any of the majors would go under, I don't think it would be Ford. So I'm fine holding the stock through this. When they suspend a dividend, they will be anxious to bring it back. Remember, a lot of the leadership and the board and all that stuff, these are all stockholders, so they're in the same boat. So it's a very mature thing to cut a dividend to get through a troublesome time, and then they will bring it back, maybe not all at once. They might ease their way into it. Kinder Morgan did that. They had this huge dividend, and they cut it, and they started easing it back into it so they could have these dividend raises over time. Look, everybody's in the same boat. If the company's not going bankrupt, you can hold the shares. If you think the company's actually going to go bankrupt, like a Chesapeake Energy or a Hertz Rent-A-Car, then yeah, you got to dump the stock, eat the loss, and go find something else that pays you your 5%. So you're not worried about the share price, but you don't want to stay completely ignorant of it either. Okay. So as far as the payouts, it pays into your account at whatever dividend payout date that is. So you'll have a record date. You'll have several dividend dates associated with it, but anyhow, eventually it'll pay into your account. And when you get that, that goes into your account as cash, or you can have it reinvested. If you are not living out of your portfolio, say you're 25 and you're trying to build a portfolio, you just want a nice moderately conservative approach, have those dividends reinvested. And through the miracle of dollar cost averaging, when Exxon's high, you'll buy less shares. When Exxon's low, you'll buy more shares of Exxon. You just reinvest that dividend and you'll have more shares, which more shares times the dividend is more total money coming in. So that's a fantastic way to build wealth. If you want to live off your portfolio and say you have most of your dividends coming in say maybe January, February timeframe, but you're taking payments every month, again, a spreadsheet, we take the annual amount, we chop it into 12. That way you can get that amount monthly. We'll leave a little buffer there in your portfolio. And basically you can get your $500 a month out of a portfolio that's generating a total of $6,000, even though the payout of that $6,000 can be anytime during the year. Some companies pay monthly. Realty income, they're usually real estate investment trusts that have to pay out monthly. There are some companies that pay out twice a year. Disney is an example. It pays a twice-year dividend. And there are some that pay out only once a year, and I cannot think of an example of that, but there are. Not that many, but there are. So again, money coming into your portfolio, it's either reinvested or not. And then when you take it to your bank account, you can take it in a lump sum once a month, once a quarter, once a year, however you want to do it. So when you take that into your bank account, when you're older, above 72 or older now, that also meets your required minimum distribution if it's coming out of traditional IRA or traditional rollover IRA. So if you have a required minimum distribution, you don't have to wait till December and take it all at once. You can take it monthly. And again, these dividends can be creating that. Okay, so in conclusion, this is a strategy for moderately conservative folks, or if you are in a situation where you are living off of the income. So you're an income generation. You are far more worried about hitting singles than you are home runs, and you will generally not get a home run with this strategy. But you will get singles like all day, every day. So grind it out, get rich slowly, preserve capital, generate income, perfect for the buy and hold investor out there. So that's what I've got for you today. Thank you so much for listening in to the On Time, On Target podcast. And here's to each of you meeting your financial goals. Talk to you soon.